The Great Gold Crash of 2026. We're talking about gold, the ultimate safe haven asset. Well, this week, it did something nobody expected. It crashed, dropping a shocking 6% in just 2 trading sessions. We're going to break down exactly how, and more importantly, why this happened.
Okay, so first, let's set the stage. Because to really feel the shock of this fall, you have to appreciate the absolutely epic rise that came right before it.
For the last 2 years, gold has been on an unbelievable run. It climbed from $2,100 an ounce all the way up to a record high of nearly $5,600. That is a staggering 166% gain. After a move like that, some kind of pullback was, almost inevitable.
What's really fascinating here is how this chart just visualizes the parabolic nature of this move. That's a term traders use when an asset's price goes almost straight up. And what that does is it creates a crowded trade. Basically, everyone is on the same side betting on the same thing, and that makes it incredibly vulnerable to a sharp, painful reversal.
The crash itself didn't start with a huge bang. It started with a critical technical break. The price sliced right through its 50-day moving average. Think of that as the average price over the last 50 trading days. It's a key trend indicator, and a ton of automated trading systems are programmed to just sell the second it breaks.
So that was the first domino to fall. The second was breaching a massive psychological level, $5,000. Losing a big round number like that triggered a whole new wave of selling. It's kind of like a mental stop loss for a lot of traders.
And this is where you can see the chain reaction just perfectly. Once those key levels broke, the automated selling programs kicked in. And then, the leveraged traders, the folks who borrowed money to get in on the trade, they started getting margin calls. That's when your broker calls and demands more money. If you can't pay up, they're forced to sell your position, which pushes the price down even faster, all the way to a 6-week low.
Okay, so we get the technical reasons for the crash, but the timing is what makes this whole thing so weird. This crash happened during the Strait of Hormuz crisis, a huge geopolitical event that should have sent gold soaring. So, why did it fall?
On the surface, it makes no sense. It's a complete paradox. Everyone expected a classic flight to safety, a safe haven rally. But what we got was the exact opposite. The very thing that was supposed to launch gold higher ended up being the catalyst for its crash.
So here's how it worked. The oil shock didn't help gold. It actually hurt it. See, surging oil prices made everyone worry about inflation sticking around. And that forced the Federal Reserve to basically say, nope, we can't cut interest rates like we planned. With rates staying higher for longer, holding an asset like gold, which pays you 0 yield, suddenly becomes a lot less attractive.
Now, to really wrap your head around this, we need to talk about 2 different gold markets, because they were telling 2 completely different stories during all this.
The price you see flashing on the news? That's set in the paper market. It's a world of futures contracts, ETFs, and it's full of leveraged positions that can be unwound fast and forcefully the second sentiment turns south.
And this really explains the disconnect. While the paper markets were having this massive fire sale, flushing out all the leveraged traders, the demand for physical metal, we're talking actual bars and coins, that stayed strong. Think about it. You can't get a margin call on a gold coin sitting in your safe.
Okay, so now that we get the why, let's jump back to the charts and look at the key battle lines that traders are watching right this very second.
So here's the lay of the land. Any attempt to rally is probably going to hit a wall of selling pressure right around that $5,000 level it just broke. And looking down, the first real test for the buyers are going to be around $45.50, and then below that, $43.60.
But listen, the most important level on this entire chart is the 200-day exponential moving average. Right now, it's sitting around $4,200. For technical analysts, this is the ultimate line in the sand, the definitive divider between a bull and a bear market. As long as the price stays above that line, the long-term uptrend is still considered to be intact.
There's no doubt, this has been a really violent shakeout. But does this mean the whole long-term bull market for gold is officially dead? Well, let's pull back and look at the bigger picture.
You see, the fundamental arguments that drove gold to those record highs, they haven't really gone anywhere. Central banks are still buying hundreds of tons of it a year. The long-term outlook for the US dollar is still pretty weak, and governments are still running massive deficits. And crucially, from a technical standpoint, that beautiful uptrend of higher highs and higher lows has not been broken. Yet.
And just for some perspective, take a look at the big banks. Institutions like JP Morgan and Goldman Sachs, they are still forecasting some serious upside by the end of the year.
They're looking at this crash as just a necessary shakeout to get rid of the speculative froth, not a major reversal of the whole trend.
This whole wild ride really forces us to step back and ask a really fundamental question about what gold even is as an asset in today's market, because its behavior has been, well, pretty unusual.
Mike McLone, over at Bloomberg Intelligence, raised a fantastic point. After having its best year since 1979, a year with relatively low inflation, by the way, has gold's personality sort of shifted from being a pure safe haven to something more like a speculative risk asset?
And that, right there, is the crucial takeaway. Is this just a sharp but ultimately healthy correction needed to wash out the speculators before the next big move up? Or are we actually witnessing a fundamental change in how gold acts during a crisis? The answer to that question is what will decide gold's future, long after the dust from this crash finally settles.